So I'm Jackie Tomes, and I run a business called Property Strategy, and also Tomes Homes. So Tomes Homes, we invest in blocks of flats on the outskirts of Kent with investment partners, and we do the buy, refurbish, refinance strategy, and we built that up since we started back in 2014. I bought the first property for £108,000, and pre-corona the portfolio was worth about £6 million. So it's been an epic kind of 7-year journey to get to this point, and from everything we've learned in building up Tomes Homes, that's what property strategy has been built on, and we're all about detail, structure, analysis, focus and clarity, and that's what I'm looking to bring today through this session here.
Wow, amazing. Yeah, we've certainly, everyone's going to take a lot away from this. I'm really looking forward to this. I'm going to be sitting in my notepad and really taking loads of notes. What I'm going to do is I'm just going to mute my mic, turn the video off, so hopefully we get as strong as possible connection for the screen share. And yeah, let's get started.
Great. Fab. So let's get straight into this. So the agenda that we're going to be covering on this morning's session, we are going to be looking at predictions for the property market values and our prediction for what exactly the curve is going to be looking like. We're going to look at the factors affecting the property market and how we see those factors that are influencing market values, how we see that evolving over the next 12 to 18 months. I'm going to talk about discounts. So if we're looking at pre-corona market value, what sort of discounts do we need to get at various parts of the curve to de-risk? And then we're going to look forwards, principles to inform your 2020 strategy. What needs to evolve and change? And what key actions do you need to take to move yourself from just survival, because that's the first thing we've got to do, then we can adapt, and then we can move into thriving. Let's remember what this is all about. It's amazing how many people are giving their time over the next few days, and it's all about this. Please donate now. If you haven't donated already, please do. If you've donated and you think you could do more, please do as well. That's the link there. I'm sure Josh will be sharing that in the groups and on the live stream as well. So please just take a moment to give what you can for a cause that really needs as much of our support as possible. So this is us. This is Tomes Homes. Our vision is about making renting better than owning. So our properties are offered to the private rented sector, and our vision is to make that whole experience through providing a high level service and through the great team that we've got to make it just superior to what else you would get on the rental market. And that vision is something that's evolved over the last 7 years since Tomes Homes was just a crazy idea when I was sitting in that ski chalet over there. So we're here in the French Alps at the moment. It was meant to be 10 wonderful weeks away skiing, but that hasn't really worked out thanks to the pandemic that we're in. But what we've been shifting, rather than being skiing for the last 5 weeks, France went into lockdown a week before the UK did. So what that's given us here is a real ability to be a little bit ahead of the curve. We went into lockdown, and so rather than hitting the slopes every day, we have been analysing, risk assessing, and seeing how we can adapt and evolve and support our clients too through this time. So I'm known as the property strategist because strategy is my thing. My background before property was market research, so consumer insights. So I worked on both the qualitative and quantitative side, and it's all about understanding human behaviour, what makes people tick. And so we've got both myself and my husband Dave, who I run the business with. We're both hugely analytical, and we come at things from very different perspectives, and feeding that research, analysis and data into actionable decision making. That is probably one of the things that we're best at. So I used to work for brands like these guys here. It was a really cool and interesting job, but the problem for me was whilst it was a really good job, I didn't like being told what to do by other people, which is what led me to set up Tomes Homes and ultimately become an entrepreneur, which I didn't really expect would be the case. And property strategy has been born out of all of that. Right, so this is a bit of a blurry screenshot, but you don't need to read the words. This is from a Financial Times article, which is tracking some of the previous recessions in different parts of the world as well. And this is the sort of thing that we've been kind of geeking out on, not only over the last 5 weeks, but also through 5 years ago, we started working with some amazing business mentors, and at that point we had no strategy, no structure, nothing, and if this pandemic had happened then, we would have been in really poor shape. But thanks to their guidance, we spent some money, invested some time in analysing the previous recessions that had come along. We knew that a recession was going to come again, and we were like, we want to know the trends and what happens so that we can be as prepared as possible for all of that. So this is the sort of stuff that we've been using to analyse and make some decisions. So I think the most interesting one to show, this one here is the green line here. Hopefully you can see my cursor on the screen there. That's the global financial crisis. And what you can see there is that drop the main drop that we had in the financial crisis here. That took, I think it was about a year and a half to actually reach the bottom there. So this is going to start to feed into the curve alongside all the other factors for thinking how are things actually going to play out over the next 18 months. So what I'm going to do is, this is a graph showing along the bottom Q1 2020 through to Q4, and then into 2021 Q1, Q2 and Q3, and all of this today is focusing on the market value of property. What are property prices going to do? So along the top here, the higher up the graph we are, the higher property prices are, and the lower the further that they've dropped. So this isn't zero down the bottom here. This is just a representation of the kind of shape and trends that we predict the property market is going to take. Now this is based on our own analysis and piecing together the puzzle, which I'll show you in a minute. What I would say is this is not the gospel truth. You take from this what you feel makes sense to you, what serves you, feed in your own stuff too. We're updating this all the time. But what is going to be really helpful about all of this is that it gives you a narrative under which to make decisions. And whether it's this or whether it's an adjusted version, we have found this so helpful to make decisions, because suddenly when everything just gets thrown up in the air, you can't make decisions on anything anymore, and it just sends you into a swirling vortex of chaos. And that is what we want to get rid of, and that's what we're focusing on here today. So I'm going to build up the picture of why we've come to this conclusion of this shape in what we feel is going to be happening with property prices, property values. So let's go back to a world before Corona, when we thought Corona was just a nice refreshing drink, pretty much. So Q1 2020, so over this side of the page here. Now we actually had a really good start to 2020. The general election, the markets were nervous about a Corbyn-led government coming into power, which didn't happen, so that the markets reacted really positively to that. So the general election led 2020 to start really strong. And also the fact that we actually moved to that next phase of Brexit, we're all totally fed up with that, we moved to that next phase. So what this meant was it looked like 2020 was going to be a really good year, where some pent-up demand was unleashed, shall we say. Then we start to, we head into Q2, and actually to be fair, I probably could have put this even before Q2, but that low Bank of England base rate. What we've got here, I'm going to be showing some different factors. If it's a green factor, this is a factor that is positively affecting the property prices, as in they are staying where they are or even rising. If it's a yellow shape, that is something that's kind of, we're not sure whether it's going to be negative or positive or what exactly that's going to mean. Then red is something that is having a negative or downward effect on property prices. So the fact that we have a low Bank of England base rate and it's got even lower, that is overall positive for property values, because you can borrow cheaply, which means people can go out there and buy properties without a lot of money, which is without requiring a lot of cash, and it doesn't cost them a lot. Moving away from that, a good factor coming into this whole Corona situation is that property is not over leveraged compared to the last recession. We've analysed all the recessions that we could, and the more data we could get, the better. Compared to previous recessions, particularly 08-09, property is not over leveraged. The regulation's been brought in by the banking industry to mean that banks have to be far more stringent about the checks that they do, and also a separate point really, but the banks have got to hold far more cash in reserve. So in terms of like banks and lending and the chance of repossessions, we're in a lot better shape than we were in the last recession. Another positive factor going into all of this is the government response. Never has there been, through recessions, such huge government support in literally handing out money as much as they can to the population. And that is going to have a positive upward pressure on property prices, because people are less likely to default on their lending. More on that in a moment. Even if they would have lost their job otherwise, they haven't, because the government have supported through that. So that's good news for rents. A lot of rents being able to be paid, at least in some form, and also people not defaulting on their mortgages. This is the next one. Is a really big one. A positive factor. Banks have been compelled by the government to support mortgage holders, and I actually think it's really clever the way it's been done, because in the last recession the banks became enemy number one, and what the government are essentially doing is saying, look, hey, this is law of reciprocity. We supported you last time, even though you'd really messed it up. Now's your turn to repay the favour. So the banks being compelled by government to support mortgage holders. They're giving mortgage holidays. The impact of that to credit files we'll see, but definitely in the short term, it's going to prevent mass repossessions, because just because you're 3 months in arrears doesn't automatically mean you're going to be pushed into repossession proceedings. Right, then we move into some of these negative factors. Now, the stock markets saw a massive drop over the last, it was probably about 3 or 4 weeks ago now. It's been bouncing around ever since. But when stock markets fall, it's very quick feedback to the market, and a lot of what we're going to be talking about as we go forward is the human psychology behind all of this. And when stock markets fall, that freaks people out. A lot of people will have lost money already on their investments. It doesn't put you in a place of feeling very confident, and that is an important factor. What we also saw as we went into this lockdown is obviously travel restrictions, and we're learning more and more that these travel restrictions, they're not just going to go away quickly. And whilst when I first started making these predictions, I thought, maybe we're in for a short, sharp shock, we'll lock down for a bit, we'll come back out of it, we'll bounce out. The way that things are moving is not looking like that at all, and those travel restrictions remaining in place is going to mean it's not great for the economy in general, but also in terms of if we're thinking about demand for property, overseas investors are probably less likely to be coming over and buying property, so therefore we're reducing the available people who are looking to actually buy property, which is not good for prices. Also, to add to that point there, I'm not sure if I've got it later, there's that recent tax change where there's an additional stamp duty surcharge for international investors, so that's also going to be reducing demand to come and buy UK property. Growth in unemployment. Unemployment has artificially been buoyed up by the government job retention scheme. But even beyond that, people aren't getting their contracts renewed. People's businesses are closing, and so obviously the furlough thing isn't there anymore. So that growth in unemployment is going to lead to less interest in buying property, because if you're in survival mode, your first thought is not to go and move house to buy a new property. So that's going to put that's the opposite to one of the green ones. It's putting a dampener effect on demand in the market. Here's when we've got lockdown come in, and at the moment I've just put it at this red point here is really like Q2 into Q3, but that lockdown, it's all of a sudden economic activity has just fallen off a cliff in a way that's never been seen before. Then that, just because it's so quick how fast everything changed, and suddenly people aren't spending money anymore, they physically can't, which is having a really negative impact on the economy, and it's not just going to come bouncing back because it's having such a big impact on businesses. More on that later. Of course, valuation challenges. We actually had a valuation booked in for 2 days after lockdown. One of my clients had a valuation booked literally the day after. Valuations are not happening. Lenders are trying to adapt, obviously, to do AVM valuations, so they're desktop valuations, but those valuation challenges are going to mean that, banks are more cautious. If they're doing desktop appraisals, they may well depress the values that they're taking, or at the very least affect the loan to values. So those valuation challenges are going to lead to depressed values, not least because it means the cash buyers are in charge, and when the cash buyers are in charge, they're going to want lower prices, and that's going to lead to a downward pressure on property prices. Reduced loan to values, that is also going to impact how many people are actually able to go out there and buy property, because suddenly those like I think there's 5-10% products have pretty much disappeared from the market. That's the resi sector anyway. But buy to let, they're 85-80%, they're gone. And even some lenders are going down to like 65%. So you need more cash to buy property right now, which doesn't help boost the demand. All of this is leading to huge uncertainty, and uncertainty does not give people confidence, and when people don't have confidence, they don't do stuff, they don't buy properties. So that is leading to less demand in the marketplace too. Now, interestingly, the fact that maybe you're not anymore, so you don't want people to come around to do viewings, you're just like, we'll just sit tight where we are for now. So that actually means there's less supply coming to the market, so in a way that helps to balance things out to some degree. This is probably the biggest one though. A huge drop in property transactions because they just can't happen. The government don't really want you to move. So a huge drop in activity in the housing market will mean the only people who are selling are the motivated ones. And when it's the motivated ones that are being sold, they're the ones that are probably accepting discounts, which is then not going to help you to help the property market prices to look higher, because really what we're going to see, and we haven't got it a true picture yet, is once I think it's in a couple of weeks' time that we should be able to see the latest market data, because it's always for the past. The most recent one, things look great, but hey, that property market data, we only get it, there's a lag to getting that data, unlike the stock market. So that's going to mean that it's going to be a larger drop in the property values of things that are going through. I'll go back to some green, but the lack of at the moment, getting planning permission through for anything, pretty much not happening. Planning committees aren't sitting, which ultimately is going to mean as we go through the next few months, there are less planning approvals, less new properties are then able to start being built, which is going to mean that the properties, the land that does have planning permission, is going to become more valuable. Maybe it only levels out, but that means there's some upward land value pressure there too. Oh, that connection is any better, Josh. I can try something different if not. So then the next phase to cover is just, and I kind of mentioned this before, that uncertainty, but also the arrears that are being built up is meaning that there's less selling, less supply, which then has a bit of a calming effect based on all of these more extreme factors. Great. Now, this is really interesting. When we first went into this, Dave and I were thinking, well, the recession, we're not going to really start going into a recession until probably Q2. So then, because a recession is 2 consecutive quarters of contraction. So therefore, we thought Q2, Q3, and then it will be at the beginning of Q4 that it becomes common knowledge that we're in recession, even though we've already been there for 2 months and everyone freaks out. But actually, March has seen such a sharp decline, we've pretty much already started that process. So probably Q1 will actually see recession beginning, Q2 is the second quarter, so actually that common knowledge will come in Q3. So I've put it in yellow here because when people don't really know we're in recession, they're calmer. But once we come out of, the official data is there and the newspapers can have a field day, that's going to create some panic, which again is not going to bring that confidence that we need for people to be active in the property market. We're going to continue to see stock market volatility as we go through the next 3 months, I think even beyond. So that's a negative factor too to people's confidence. And then as we continue through the year, yes, there's some great measure that the government's doing right now, but the problem is they're essentially building up a load of extra debt for us. They're compelling landlords to be kind with rent payment deferments, mortgage payments are being deferred, you're allowed to defer your tax bill, the VAT bill. And this is us personally, but also as a country as well. We are accumulating a lot of debt, and that is going to have an overall negative impact to people wanting properties, and just that drag that we'll see, even if the lockdown did ease after, say, 3 months, we're still going to have this drag because of that. Interesting one, Brexit deadline looms. I've got that, so end of 2020, maybe you might think, well, maybe things are starting to get back to some version of normal. Maybe things will start to pick up. Now, I think the difference here is Brexit. The Brexit deadline, the transition period, ends at the end of December. So where there may have been some confidence returning, everyone's going to get obsessed about Brexit again, which isn't going to be good for confidence. People are going to be waiting and seeing, kind of like they were. at the end of last year, or even last year or the year before in general, just that Brexit concern has put a lid on the property market in general. So Brexit deadline is looming, so therefore that continues to have a negative effect. We then start to see the lockdown measures starting to release. Depending on how that looks, that could be slightly more of a positive factor. One thing that we've got all the way along the bottom here is that social distancing is going to continue in some form until there is a vaccine. And from everything that I've read, we're looking at 12 to 18 months until we have a vaccine, and actually hearing more about the fact that it's mutating as a virus. You know, who knows how that's going to play out. And that social distancing is going to have an effect on the wider economy and on people's confidence too. So that is going to have some impact as well. Then we go, as the year progresses, how is that government support going to evolve and change? Because can they keep throwing money at the situation like they are now? Probably not. And some more businesses are going to fail. And what happens when the banks don't have to give payment holidays anymore? How is that going to play out? So I've put that as a yellow because I don't quite know what way it's going to go. What we may well see in the last quarter of this year, as things are starting to get moving again, is a build-up in latent demand. Now, that's only a yellow at this point because I don't think it's going to be really strong, and I think partly due to the Brexit situation. If Brexit gets pushed back to next year, I think we could be in for an even longer downward trajectory. I've put here increase in divorce rate. Now, I stopped short of putting that in green because that just felt wrong. But really, what a divorce rate, if we're just being really cold and hard about it, means an increase in the number of households. More divorces are going to happen because we're stuck at home. Love you, Dave, with our partners, and that's going to increase that chance that you realise that you've had enough. So increasing divorce rate could mean that coming out of this we have an increase in the number of households, and that's probably households could be purchasing but could also be renting too. So that could potentially have a positive impact on property values. Potentially, if we can get Brexit done at the end of this year, I think that's a really positive thing. No matter what really happens, I think just having that certainty is what the market is really missing at this point. What we are hypothesising is that stock market confidence could start to return at the beginning of next year. I don't necessarily in a big way, but I think it's just going to be a gradual build as lockdown starts to release, businesses start to get back to a new way of working, and we start to have a bit more clarity on how the situation progresses. So those businesses building momentum, which is good, but I don't think it's just going to be like turning back on the tap again. You know, you've furloughed workers, you had plans that have changed, all that great momentum that you had forward. We found it in our own business. We had great plans for this year, great forward momentum, and all of a sudden everything just stops and you have to reassess. And then getting that new plan going again is going to take that build of energy like a turning wheel does. Potentially pent-up demand being released at the beginning or early parts of next year. More certainty returning in terms of how things are working will lead to more demand. Downward deferred taxes are due, personal taxes become due that the government let you push back, not good. And we think that actually all of these factors, and because there's always a bit of a lag to how things work, that the recession really is still going to be continuing to the beginning of next year. But as these green factors here start to build that momentum, we think that coming out of the recession, I'm going to slightly contradict myself in a moment, but potentially towards the middle to latter part of next year. I've got baby boom here. Not only are we getting fed up with our partners, but we're also bored as well. So looking at maybe some more babies coming along at the beginning part of next year. And that baby boom ultimately means people's families are growing. And if they can possibly do so, they're going to want a bigger place for all their growing brood. That's the word, isn't it? So again, an increase in demand for new houses and activity in the housing market. And then got towards the end of 2021 here, potentially there's a vaccine, and then once we've got that, maybe they'll never return to normal, but closer to normal on the back of having that's going to be a really good factor too. Now, the only thing that's just changed is I've changed that. So if you look down the bottom of the slide there, I've just slightly changed the timeline, extended it. Now, I didn't have time to redo this whole slide, but the more and more that I hear about, particularly how the vaccine how important that is, and how much of an impact this is having on businesses, and businesses going into administration, maybe even folding like completely, I just feel more and more that this could be an even longer curve. And so whilst I'm not saying that the vaccine is going to be moving back to Q1 2022, but maybe some of these other factors, everything just kind of stretches out. So that is something that I'm going to be playing around more over the days that come, because I think potentially this could be a bit of a longer situation here. But hey, good news! Around this time in 2020, the Property Conference raises over £10,000 for the NHS. That's right, guys, that's what we're doing right here, right now. So just a little reminder, please donate now. Josh, I'm sure you'll pop in the donation link in the chat box or on the various pages. I hope you're enjoying this. This is all in aid of the NHS and supporting them. So please donate again now. If this has given you any ideas or inspiration for how you're changing, how you're running a business, in return, I'd love you. Please donate to the NHS. Thank you very much. So, that's like a load of information there. In summary, what we're looking at? We're entering a recession. It's already beginning. It's not official yet just because of how it's done, but we're entering a recession. And the big problem for us, this is all about property at the end of the day, the lack of ability to assess market value right now means we need to be really careful about the discounts that we are getting on deals that we do. Because this isn't the time to completely F up your property business. This is the time to make sure you are de-risking and taking the advantage of the opportunity, but in the right way. So, banks reducing loan to values and surveyors downvaluing. This is overall a negative thing for the property market, and it is going to have an impact on your deals. If you've got deals that are exiting this year, what is the valuation situation going to be? So we need to be careful about how we play, particularly I would say the next 9 months. And banks reducing loan to values, it could look like more money's being left in deals. What this will mean in the short term is that I think yields are going to increase. Property yields will increase because values are going to drop, and that's what happens. But then, because especially with buy-to-let, like it is the most solid property investment at the moment, compared to the alternatives. That's our main business model, and as more people choose or maybe adapt to doing that model more, there's going to be more supply, which will then have a downward pressure on rents, I hypothesise. So going back to this general curve again, what the important part of all of this is actually timing. Timing is a really important thing for us to consider. If you are buying at the market value or the value that you agreed 3 weeks ago, even if that was 20% below the market value at that point, that is not going to be 20% below the market value now. We don't really know how quickly the market's dropped. We'll find out when the next round of data comes out. But what this means is we are heading down towards the bottom of how far the property market has fallen. I think I read that, I've forgotten the name, but quite a big leading body in research, they thought 5 to 10% drop. That was a few weeks ago now. I don't see how it can be less than 15% on average across the country. And from some of the conversations that we've had, potentially the north could be worse affected than some areas of the south. We shall see. But if we call it an average drop that we're looking at of probably 20%, let's plan for that. That's how far down we've got to go. Now, this is not to say that the bottom is definitely going to happen here, but this is our prediction about when it could be. So then we've got a basically 9-month downward trajectory towards that, and probably a very steep initial drop, and then maybe I think it will flatten out more as economic activity starts to find some way to return to some sense of normality. So if we were to say that this first part of the curve here will see a 12% drop, what we're then looking at, you've still got a further 8% to go. So that's the bottom point there that we're looking at. And so then each month, what you are potentially looking at is a 4% drop per month. That is really flatlined, and I don't think it's going to be as linear as that. But let's kind of work on that basis. So the point of all of this is to say that if you buy at whatever the market value is at this point here, In terms of refinancing, because that is a play that most of us are using in some way in property, if you buy at the market value here and your model is some kind of buy something refinance, then you're gonna need to wait until we're at a similar place in the market, but over here. So the less aggressive you are with the discounts and the more you pay for the properties, the longer you are going to have to wait to be coming out the other side again. And I think it's just a really good representation to have in your mind, is if you're buying here, in terms of timeline, you're going to have to be waiting to refinancing here. So that is like, what we're looking at, like 18 months. Now maybe your normal refinancing time frame is 6 months. So if that's something that you're wanting to be sticking to or trying to, you're going to have a bigger discount than just 4 or 8% here. You'll need to be aiming more towards the 20%, if that's the hypothesis that we're saying, in order to mean that you can refinance sooner. One of the really tricky things in property that we have to contend with is the lag. So the first property that we ever purchased, we purchased in the last recession. This was our home. We actually completed on it in April 2008. God, stuck in the 20s. In April 2009. We agreed to buy that property at the end of 2008. Now, April 2009 was officially the bottom of the market. But really, because transactions take time to go through, the actual bottom of the market was really 3 months before, when people were making offers. So there's this weird time frame dichotomy that we have to wrestle with in order to make sure we are kind of timing the bottom without actually really knowing when that is. And so having that hypothesis about how far you feel it's going to go and planning ahead and also being patient is a really important factor to doing the right kind of deals. And we have to be more professional now than we've ever been before. Because this is not the time to just put your finger in the air and think it's great. This is the time for research, data analysis, and then action taking. More on that later. So here we go. Some broad principles to inform your new, shiny, wonderful 2020 strategy. Let's try and be positive about this. So the first one is that 2020 is going to be a tough year for refinancing. Review what plans you have in place for 2020. We had a handful of refinances planned for later this year. We're not, that's all under review essentially. We don't think this is going to be the year for releasing equity from properties, and so it might just be having a delay of 6 months might make the difference to getting back on track. But I would plan for this year being very tough, because not only are valuations going to be hit, but loan to values are also hit. So kind of like a double whammy of cash getting stuck into deals. So it's going to be hard in the next 6 to 9 months to do short-term capital plays, because we do not know when that bottom of the market will be. So if your model is normally flipping, where you buy something, quickly turn it around and get it back on the market again within 6 months, you're probably going to want to rethink that, because how confident can you, well, it's very hard to be confident at all on what the values are going to be towards the latter part of this year. So that is a high risk strategy. And uncertainty about knowing how long lockdown will be. We're all in the same boat, but what I would just be really careful about is hope. Hope is not a strategy. I would plan for this lasting longer than you want it to and make new plans accordingly. Don't just hope that it's all going to be fine and that things will come back. If you can take some action now and adjust things, you don't need to rely on hope, and that's going to be painful. I'm not saying that it's not. We've made some really painful decisions over the last few weeks, but that's life, that's business. So there's going to be difficulties exiting in the way that you normally would as we go through 2020. So we need to adjust, particularly that time frame side of things. And I personally would put a huge caution on high interest finance. So let's say finance, not finances. If you're going to buy something on bridging finance and your plan is to quickly turn something around, or maybe even 6 to 12 months, how much confidence do you have to get off that bridge? That is a very stressful situation to be in. So just be careful on that high interest finance and how exactly you set that up. If indeed you do, can you pivot how exactly you're financing your deals to mean that you're not exposed in that way? And here's the kicker. The deals have got to be better. Or maybe you're great at deals anyway. They need to continue to be as great as they normally are. So we need to accommodate the fact that there's a highly increased chance of values dropping, and so therefore it is riskier. And this one is from my lovely husband, Dave, Detail Dave. He's the spreadsheet guy. He's the patient one, I'm the impatient one. But it is, patience can be a virtue. Just really consider your timing on your next acquisition very carefully. Because I know we all think, oh, well, when everyone's scared, you do the opposite. Yeah, but you do the opposite, but do it with a plan, and do it having thought through where things are going. Because if you can time this right, 2020 could be a great year for you. If you're impatient and you just forge ahead like a bull in a china shop, it could be a really bad year for you. And so with some of this extra time and this patience that we're going to be exercising, now is a really great time to work on strategy and systemization. And I'll share some ideas about that as we go through. But one great one that I wanted to share with you all today is that this is something that you can, that we have created. It's called the Scalability Score Assessment Tool. It's completely free. And this is an online assessment that you take. It takes about 10-15 minutes. It asks you 30 questions about your property business, and it will give you a score across the 5 key areas of strategy: sourcing and acquisition, funding, delivery, financial management, and team, as well as an overall percentage score. And this is how scalable you are. So how good is your infrastructure, your team, your systems, your processes? So we've created this to really raise the profile of what great strategy is. So this is something that you can go and do today. And I recommend you do it today because I would like to do something different today, which is that whilst this is a free tool to do, for everyone who goes on and completes this today, and that will support your own business, I will donate £5 for every assessment that is completed today. So this means you get to do 2 things. You get to support your own business and you get to support the NHS without actually having to pay that either. So everyone go and make me donate loads of money to the NHS. So that is, Josh, if you're able to share that link in the chat, that'd be awesome. So yeah, please go on, find a way that you you'll get a 60-page report. It's completely bespoke to your level, and then you've got something that's really tangible, broken down action steps that you can take to improve your strategy, to improve your systems through this time. And then I'll tally it all up tomorrow morning, and I will make a donation for how many people have also improved their businesses, which will be awesome. Right. Let's go into the business evolution blueprint. So this is about adjusting your business model. So we've given some principles about how the market's going to go. So what do you do in response to that? So there are 4 key areas to help you adjust that, how you're operating, how you pivot. So first one is time frame, which I've alluded to quite a bit already. Then how do you adjust your business model accordingly? What finance are you using and how can that change to make it less risky? And what's the sort of condition of the properties that you're working with? So time frame. Can you amend the refinance time frame? So maybe you normally buy refurbished refinance within, say, 6 to 9 months. Obviously 6 to 9 months would be a great time to refinance. Could you adjust your deal to mean so that you're refinancing in 18 months or 2 years, or maybe even longer? Could you adjust the approach that you've got? Also time frame to purchase. So maybe you've already got some deals in the pipeline that you've agreed at I call it PC, pre-corona prices. So then maybe the vendor's happy to wait, but they want that price. So you could do something more creative where you've got some kind of option or a lease option, but just getting the timing right on when you actually complete on that on the basis of when market value is going to be back in your favour. And also the timing of renegotiation. I'm sure, like we do, you have deals in the pipeline that you're trying to buy that you've agreed at market value 3, 4, 5 weeks ago. The problem is, going back to the timing and the lag that we have with data, vendors who are selling their properties will believe that their properties are still worth what they were then. So if you go back and, unless they're really motivated and try and renegotiate too soon, you probably find that you don't get a great response. So timing that renegotiation to be in line with how people's mindsets evolve. Then you've also got the end, so business model, some considerations here. Who is your end user? Who, if you're a large portfolio landlord, who are your tenants? Maybe usually you have professional tenants, but maybe professional tenants are not finding it as easy to pay their rent as they used to before. Could you adapt who you serve and diversify the sort of customers that you have in the portfolio? From the risk analysis that we've done, approximately 50% of our rent across the portfolio is in some way backed by the government, so it's benefits in some way or another, which has actually given us a really nice blend of different types of income, which has made it more robust. Purchase type. So exactly how are you doing it? Could you be more creative? Could you do assisted sales over a longer period of time, or even assisted sales within this time frame could mean that you can get a better, you can make a deal work where it wouldn't before. Maybe a joint venture with the like with the landowner, for example. How exactly are you purchasing it, and could you be more creative in that approach to make something work where it didn't before? I think if rent to rent could be a really interesting opportunity for those landlords who haven't got a great arrears management process. If you can, even if it's quite a lot lower than market value, give that guaranteed rent, that's going to really help. And also, of course, the purchase price. So what percentage discount do you need to get on the pre-corona levels to actually be comfortable? So being really clear on that. Finance. What type of finance are you using? I've alluded to bridging finance. Could you pivot the exact finance that you're using? So one of the deals that we've got at the moment, we were planning to do, it's a block of 5 flats, we were planning to do a buy, refurbish, refinance approach on it and get out within 5 to 6 months. So we're doing buying it on a bridge and refinancing to a term product. What we are looking at is, because it's, you know, it's not in our normal standard of condition of property, but it's perfectly livable and perfectly safe. So what we are considering at the moment is proceeding with it in its present condition, not getting it with vacant possession. It means you've got a cash flowing asset from day one. It also means that you can purchase with term finance from day one, which means that it really de-risks. Because for me, if I'm stuck on a bridge paying 12% and I've got no clear exit, that is that's pretty like no-go territory. But if I'm on a term product and we've got our investment partners, we've all agreed on what the plan is and what the exit's going to be, maybe in say two years, maybe even 18 months would be enough. Looking at your interest rates as well. So we had some deals lined up. Again, when you get in and out quickly, you can pay high interest finance. But if you're in for a longer period of time, that's really hard, much harder to do. So maybe you could renegotiate with your investors, potentially looking at lower interest rates, but over an extended period of time. And that's going to be in return for doing a lower risk deal. So, you know, looking at some of the other investment opportunities at the moment, if you can provide maybe cash flow along the way, that could be a great proposition. And capital requirements. This is an interesting one to like play around with too. Perhaps you need to factor in additional cash required to do a deal so that you've got some cash buffer there to support that deal, just because the likelihood of arrears is so much greater than normal. Oh, wrong way. And then finally, condition. Maybe you were planning, one of my clients is planning to do a flip, so it was buy it, do it up, sell it on. But actually, same kind of situation to the one I just described, it's livable condition. So instead, could you do just rent it straight away and plan to do a refurb in the future? So it's more like a short hold, where you rent it out for a short period of time. When that tenant moves on, you refurbish the property and then you sell it on. Could you flip around that? So just changing, moving from major works to more light refurbs, particularly with the challenges that we have during this time of contractors being on site. So could you play around with what condition the properties that you offer are, so that you can continue to operate in a lower risk way through this time? So, some additional considerations for your 2020 strategy. How are we doing? Good. Open your mindset to different time frames. I think I've made that one very clear. You really focus on cash flow in the short term. And I don't think it necessarily needs to be the highest cash flowing assets. Like, in a way, HMOs are higher risk because of being able to, voids, once they're there, they're harder to fill. So even if it's a lower, even if it's buy to let rather than HMO, if you can get it cash flowing and you can sort out your arrears management process, that could be a really good way to move forwards. Factor in that cash buffer more than you normally would to cover arrears and to cover longer voids. And adjust your assessment methods for the risk of different types of tenants. Because you don't, if you're going to buy a property that's already got a tenant in situ, we want to just avoid creating a liability from day one. And that could just be even how you set up your relationship with that person from day one and just how you manage that moving forwards. So you've got to factor in an estimated drop in values over the next 9 to 12 months. That's really, really important. So what I'm going to go through now is quickly across survive, adapt and thrive, some key actions that you can take in your property business to move forward through 2020 and to really start to inform your 2020 strategy. So kicking off with survive. Survive is about ensuring that your business comes out the other side of this. That is the priority number one. Until you've done that, you can't get to the other 2 points. So risk assess your customers. This is something that we did 4 or 5 weeks ago now. We looked at all the tenants that we have across our portfolio and found out, or if we already knew, collated the list of different professions of those that rent from us, what percentage of their rents are supported by benefits, and got that all into a spreadsheet so that we could see overall what percentage of our overall rent roll we felt was at risk. And from that analysis, and when I say at risk, I mean at risk of deferment, because everything's a deferment. It's going to have a very interesting effect on the economy. I think I've been sitting on a committee that's been building in some advisory points that's gone up to the government. And one of the things that I was really rallying for was stop calling it a holiday. This is not a holiday. This is a deferment. So I think just making sure that you've assessed that and seeing how much you feel is at risk of deferment. So we reckon it's about 17 or 18% of ours. We're obviously coming towards the end of the month, beginning of the next month, so we'll see how true our hypotheses are. But when you've got that risk assessment and you've got that figure for what percentage you feel is at risk, you can make decisions around it. And that's what we've done. We've gone back to, we've pushed back and amended our cash flow forecasts. More of that in a minute. Risk assess your deals. The deals that you agreed pre-corona and now. What did things look like for that deal there? What were the risks that you had on that deal pre-corona, and what do they look like now? So, for example, the risk of downvaluing is probably way higher than it was before. But I think this is good to get perspective too, because I think because it is so present in all of our minds that we're in a bad time, we just kind of assume that everything is awful. But it's not, and I think if you can look at your deal, and maybe you had a risk assessment that you did before coronavirus, or if you didn't, go and do one, think back, and then say what has changed about that risk assessment from before coronavirus to now, and it will just give some perspective, because those risks were all still there. It's just the likelihood of those risks coming to fruition is much higher than before. A decision to not take action can also be an action. Now, just not taking action because you're burying your head in your sand, that is not me giving you permission to do that. No. This is to say, if you go and risk assess everything, you do the work off the back of this call, and you decide that actually the best thing for your business right now is just to wait. That is an action. Don't feel like you have to be doing things just to make you feel good. That's pointless. And so decide how you want to play it, and if that means you're just saying, you know what, for the next month, 2 months, I'm just going to watch this out and choose my timing carefully, that can be an action too. And this one, through my wonderful Detail Dave and Bernard, who's our financial controller, ensure you have a quality cash flow forecast. Now, those of you who are more experienced in this call, you probably have a cash flow forecast already, which is great. Now's the time to look at how you can actually improve that, and that's a really good time to do that. If I'm talking cash flow forecast and you've not a Scooby what I'm talking about, now is the time to learn, because we need to be able to look ahead for your business, what is happening over the next 9 to 12 months from a financial point of view, and how is that impacting your bank balance. We need to know. Mentioned it many times already, improve your arrears management process. What happens when someone can't pay their rent? What's the process? How do you manage that? What's your communication with your tenants or customers, whoever they are? Improve your arrears management process to ensure that coming out the other side of this, and it may take time, it could take a couple of years to bring the deferment back up to date, but if you've got a good process, it need not be lost revenue, it can be a deferment. It should be. Number 6, build your cash reserves. This is something that our business mentors told us back in 2015, and we have focused so hard on it ever since then, and it is really hard to do in property because we see like 100 grand in the bank and we go, could put that into a property deal. So it's really hard to keep cash in the bank. If you have got cash in the bank, great, well done. Make sure you are holding on to as much of that as you can, particularly through this really uncertain period. And we've bolstered our cash reserves by just drawing down on some interest-free credit cards. I don't think we're going to need it, but I just wanted to grab it while it was there because who knows how that finance area will change. So we just grabbed it, paid a couple of % in a fee to do it, shoved it all in the bank account, and it's like an insurance policy. So that's helped us to further bolster our cash reserves, which gives comfort and helps to sleep at night. But you can also do that by cutting down your expenditure, which I think might be on my next one. But how can you spend less now to build up that pot, even if it might seem so small and inconsequential? Every little helps. So build those cash reserves as best you can. And number 7 is get communicating with all your stakeholders to reassure them and to gain insight. So by stakeholders, that is your team, that is your tenants, your investors, it could be your guests, you may have some long-term guests staying with you, your landlords, whoever it may be. Pick up the phone and get talking to everyone. Just check in. Like, I think just being a lovely human at this point and just making sure people are okay counts for such a lot. So get communicating, but also use that to find out how they're doing and use that to build into your risk assessment, because maybe it's not the answer that you want to hear, maybe things are worse, but at least if you know, you can actually do something and plan for it. How are we doing for time? Oh, doing pretty well. Okay, adapt. 4 key actions here. Accept this isn't going to be quick and adapt now. Don't mull on this. Just do some assessment, do some thinking, and make some changes now. Pivot. Renegotiate your current deals. Don't be shy about this. The world has changed, and you just being polite and carrying on with the deal at the current price is not going to be good for the long-term health of your business. So time it right, but you're going to need to renegotiate those deals to ensure that you're not overexposed. Here we go, that was it. Streamline your overheads. So what can you cut back on? This is from a business point of view and a personal point of view. How can you cut back? What can you push forward? So maybe there's some non-essential stuff you were planning to spend that you don't need to. Just really be ruthless. Streamline how much money is going out, and this can actually feed into the Thrive part 2. More on that in a second. Number 4 is adapt your investor avatar. The way you're doing your deals, the way you're shifting your business model may well mean that the sort of investors that you normally work with are not so keen. You may need to have a slightly different type of investor who would be interested, or the sort of investor who's interested to carry on buying deals in 2020 when others may not. So if you can adapt what exact person is going to be the right sort of fit, then you can really focus your attention on building up that pipeline of funds to be ready to go when the timing's right. So there's plenty of stuff you can be doing, just you don't have to be doing deals to be getting ready to do way more deals when the timing is right. And I hope that this session here has given you loads of thoughts and ideas about building your own risk assessment strategy and how you can adapt, and communicate that. Share that with the wider world, share that with your investors, because someone who's just like, I feel I might go and buy some deals at this point is not a great person to invest in, but someone who's thought it through, that has a plan, that's got a way to mitigate the biggest risks right now. People still want to invest. And big inflation is coming down the line. So just having your money in the bank at that point, not going to be a great proposition. And then finally, we're going to Thrive, 5 key areas. From all of this, I'm not trying to I'm doing the opposite. No, it's not about scaremongering. It's just about being realistic and practical, assessing, analysing, and then getting on with it, but at the right time. So do all of this, make a plan, and then execute on it. Don't just sit on your hands. That is how you can thrive. And if you can time the purchasing of your deals at the right point in 2020, this really could be the making of you. So keep that in mind, but remember patience. It's a real balance. I'm all about the balance. Externally communicate the above, particularly to your deal source, not deal sourcer, because it might not be a sourcer you use, but where do you get your deals? Keep in touch with them. Let them know where you're at. Let them know that you're not going to be sitting on your hands in 2020. You are going to want to be buying stuff. but it's not going to be at the pre-corona prices. But when someone's ready to sell, you're here. So communication. And those streamlined overheads, build on them. And there are so many overheads that we take on that, do we actually really need them? You know, everyone's working from home right now. Maybe you're paying out for an office that all your staff normally are in. How's it going? Could you actually not have that office out the other end? How much cash flow could that add to your property business if you can find a way to work remotely? So don't just come out the other side and go back to where you were before, but if you can keep that streamlined overheads, you could see your net profit increase dramatically. So yes, turnover is a sexy number, your total rent roll is a sexy number, but who really cares? It's the net effect of all of that. So if you can streamline your overheads, you could have far more from what you already have. Keep building and strengthening those relationships. So if you're reaching out to everyone now, use that as the beginning of a new chapter where you do reach out more, from your deal source to your investors, perhaps to your banks, to your tenants, to your team. Use this as an opportunity to have a whole new chapter in terms of wider culture from your organisation. If you're there for your team at this point, they're going to really appreciate it. So build your culture through this time. And focus on improving your systems and your infrastructure during this quiet time to be ready to scale up when the timing is right. So on that point, a few key ideas for what you can do. This is all bulked out in way more detail on the Scalability Score report if you want to do that. But here it is, systems and strategy, some key things that you can focus on even if you can't leave your house. Your pipelines, your property and investor pipelines, your landlord pipelines if you are a letting agent or you do rent to rent. How do you manage that process of someone being a potential opportunity all the way through to them actually being a client of yours? Is it all on pieces of paper? Is it all in your head? Now's the time to get it out of your head and into some kind of process. If you're just starting out, an Excel spreadsheet is probably fine. And those of you who are more established on the call, you're going to want some sort of CRM system to manage all of that. So you'll build your pipelines, figure out what those distinct stages are and how your opportunities move through it, so that you can ultimately get your team to support you more in the progression of potential opportunities. Criteria, your deal and investor avatar. This is going to change based on the work that you're doing to your business model. Your deal criteria will change, so make sure you're really clear on that. Your deal sources are really clear on that, and same with your investor avatar. Review what sort of investors you're working with, and make an action plan for what are going to be the right sorts of investors through 2020 and into 2021. Build those relationships. I think I've covered that enough. Number 4, lettings. We brought our lettings in-house back in the summer last year, and we have seen our arrears drop, our voids reduce dramatically, our rents have even increased where they were decreasing before. And so what that has meant is the net effect for having our lettings in-house is our net profit has increased by like 50%. It's been huge. So if you have got a decent sized portfolio, this could be something that you might be worth considering during this time. If you've got time to set up something new, this could be worth considering. Your financial management systems, cash flow forecast, have you got a clear balance sheet? We've, in our team, put a huge amount of focus and energy on it. We've got Bernard, who's amazing, who's set up an amazing dashboard for us. That's taken years of work, but it just started with a very simple cash flow forecast spreadsheet. So wherever you are, now's the time to improve those financial management systems because they are integral to surviving and ultimately thriving through these times. And then wider operational infrastructure. How do you manage your tasks? How do you communicate with your team? Maybe it's a bit disparate. Can you streamline all of that, make it work better, make it more efficient so that coming out the other side of this, you have a business that is far more robust and ready to scale? Here's a great way that you can find out more about what you can focus on and broken down into real nitty-gritty chunks. And when you complete that, at the end of the day, for everyone who completes this assessment today, I will donate £5 to the Virgin Money giving page. So let's get that up again. So here's what actions you can take off the back of today. Please donate now if you haven't donated already. Please go and donate to the Property Conference. There is the link. I'm sure Josh is sharing it as well in the comments. This is yes, we're in a very fortunate situation working in property. I look at other businesses compared to ours, part of some incredible entrepreneur groups, and I look at the struggles that they're having compared to the struggles that our clients and our wider community are having, and we are in a very good situation. So let's use our good fortune to support those who are really going through the ringer right now, and you can do that here. Go to uk.virginmoneygiving.com/propertycon and donate, and you can increase your donation without spending any more money by taking the Scalability Score Assessment tool. So that's, you go to our website, property-strategy.com/the-scalability-score, and do it today, and I'll donate £5 on your behalf to the NHS. So that's me pretty much done with the main part of delivery that I've got. I'm ready to take any questions that you may have. So Josh, please do fire them over.
Yeah, absolutely. First of all, thank you very much for that incredible presentation. So much value and really no detail spared on that. You're very thorough, and a lot of people have taken massive value from that. Let's just see where the questions are. So we've got a couple here. So we've got one basically. So if you're purchasing a property now,
yep,
what's the best thing to do? Is it kind of best to put out or renegotiate the price? What would your recommendations be if you are currently in the process of purchasing a property?
I would say my first reaction would be to look at how you can make it work still, but that's ultimately going to be a lower price in most cases. Or maybe if is the same price, it needs to be a more creative approach, like a lease option, for example, where you've got an option to buy for the next 5 years, but at the current price. So it might be an adjustment to your business model would mean that you could still make it work, or it just might need to be that you drop the price. And I think particularly with like projects that were planned to be refurbishments, where you were having to buy on bridging finance, if you could pivot that to be something where you could just rent it out from day one, and you're probably going to have a larger void at the beginning, just because of the challenges of getting things rented at the moment. But if you can factor that into your figures and get it at the right price, and so for us, we're looking at least 15% drop on our current agreed prices to feel comfortable to proceed. And then that's also, if you remember the curve, if it's 15, if we think it's ultimately going to be a 20% drop, but say we buy for 15, it's just going to mean that the timeline to being able to refinance is just going to be further down the track. So it might just by extending your time frame might make something work where it otherwise wouldn't. So yeah, take that the business evolution blueprint, look at the deal, look at the exact business model, look at the timeline, the way you're financing it, and the condition, and just see what you can pivot as part of that deal, and see, there are probably a few options, see what could work.
Yeah, absolutely. Yeah, fantastic. So another question, say, will there be a greater divide between the kind of the have-nots and have-nots? Will there be kind of more bias against the landlords and property investors? And do you think this is going to lead to any kind of government intervention? Or as you go into recession again, and maybe people start hating on landlords, can you see any of that taking place?
I think it can't really get much worse, can it? Like we're already public enemy number one. I think Richard Branson's taken a lot of flack and a lot of attention away from us at the moment. No, I actually think it could almost go the other way, because I think the majority of landlords, and maybe this is something we need to be finding a way to communicate, so most of the landlords that I know are doing their level best to support their tenants through this time. So I think, no, I don't think it's going to get any worse for landlords than it already is. And to be honest with you, we, just by the nature of how things are set up, just have to be more flexible in our approach, because we don't, it's harder to go down the route of pursuing someone for debts than if you're a bank. So no, I think we're going to be all right, and I think ultimately, I reckon my money's on I think Section 24 might be delayed because there's going to need to be support to ensure that landlords actually continue to rent their properties to the people who are in arrears with them. But I also reckon that the 3% surcharge, I reckon that will be lifted for a period of time, because they're actually going to need us to keep the housing market from tanking in a way that ultimately affects residential owner-occupiers. So, no, I think we're all right. I think it's not going to get any worse than it already is.
Yeah, so yeah, at least we've got that to look forward to. And I agree on there. I think there's already talks of a stamp duty holiday, just to try and get the market moving again off the back of this. Are the rent-to-rent models and service accommodation are still viable? I suppose even referring back to the kind of graph from earlier on, it's kind of downward slope for the next couple of quarters. How's service accommodation going to fare throughout this, do you think?
Yeah, I think service accommodation is probably, well, that and HMOs. But service accommodation is potentially a bit worse. You just really need to, the ones who've really pivoted and built relationships with people, like key workers, for example, they will do well. One interesting thing is, I think when we are unleashed from our lockdown, we're going to want to get out of our house, and we're probably not going to really want to go overseas, or maybe even be able to go overseas. So therefore, UK holidays will probably increase, plus they're cheaper and everyone's tight for cash. So actually, if you're in an area where you could appeal more to holiday makers, that could be an interesting adjustment for more of a focus there. But yeah, I think factoring in, if you're going to do further service accommodation deals at this point, it's more important than ever that they also work as a single let, as a backup. And maybe you could de-risk it by, if you're doing rent to rent with serviced accommodation, you're doing, rather than the guaranteed rent approach, a joint venture with the landlord may well be better, or doing it on a management fee may well be better. But yeah, I think I would, if I was doing service accommodation, I'd be cautious about taking on new units. And actually, that's kind of what I'm thinking about when I'm saying don't just hope it's going to be quick to go. Maybe it is worth just covering your costs for the serviced accommodations. If your insurance and if your bank allowed you to do so, pivot and just put a longer term person in there who just covers the costs. That might be worth considering.
Yeah, absolutely. I think that for a service accommodation at the moment, if you're breaking even, then you're doing better than the vast majority of people in that sector at the moment.
Absolutely.
So another question. So is now a good time to sell, just to kind of be ahead of the curve in terms of the price fall that's going to happen?
I reckon we might have missed the boat already on that. Unless you can sell very quickly.
Yeah.
I think you may have missed. Well, it depends. I think I probably would want to be quite motivated to sell something at this point. Maybe if you were able to sell something in the next 2 to 4 weeks, that you might not be hit too badly. But I think beyond them, I'd be trying to hold on in, as long as your cash, you can make it, not be a liability in the short term, and you've got enough cash reserves. So yeah, kind of quite dependent on the situation.
Yeah, absolutely. I suppose even if you just kind of sell that quick, unless you've got really, really good property, there's going to have to be some kind of implicit discount into that unit. So really, if you don't have to sell now, it's probably best not to.
I reckon so.
Okay, any other questions? So you mentioned CRMs. Are there any you use? And what would you recommend for other people?
So we, up until very recently, used Less Annoying CRM. Ridiculous name, but it's I really like the it's really simple. Like, if you're not used to using CRMs, and it's like £7 a month or something, so it's not a lot of money. So that's something that we've used. We actually use Asana as our task management system, and we've started turning, because you can do project boards on Asana. So we use that now as our pipeline functionality, because we've got we're on premium Asana. So I was like, right, I'm not paying for Less Annoying CRM anymore. And then for our training company, we use Infusionsoft, but that's quite a more expensive system. But yeah, if you're brand new to CRMs and you're not sure where to start, I think Less Annoying CRM is a great place to start.
Right, perfect. Yeah, that's really helpful. So in terms of kind of what strategies or what your main focus is at the moment, what are you going to be doing over the next kind of 3 to 6 months to try and kind of capitalise on the fall in prices best?
So we will be, well, from a risk management point of view, we don't want to be buying anything on bridging finance. So we're going to be adjusting how and what we buy to be on a term finance from the very beginning. And that may mean that we can't do, we're not doing refurbishments at the beginning. So so focusing more on buy something that is pretty much cash flowing straight away, manage it well in the short term, and then when the timing is right, move to just refurb, because we buy blocks of flats, so we'll just refurbish the individual units as we go through. So I think we have got a few deals that we're buying at the moment. It's just about getting the timing on renegotiating those right, and it's still not time for that yet. I've had a little note to look at that again at the end of this week, and it's not time yet. I reckon maybe another 4 weeks until we start to look at going back and renegotiating those. But it will be just a case of us keeping a really close eye, keeping us plugged into as much data as we can to decide when exactly we strike. So yeah, refurbishments pushed back where possible, term finance rather than bridging finance, cash flow as the focus.
Right, yeah, amazing. So in terms of kind of commercial space, what do you see happening with commercial property? Do you think we're going to kind of lose a lot of the offices as people start working from home and then that gets converted to residential? What's your kind of thoughts about that?
I think it's really interesting with offices. I think people are going to have missed that if you're used to operating in an office, it's such a big shift to just moving completely away from that. So I think maybe there will be some, but I think perhaps not as much as we're all imagining. Like Zoom is great, but nothing. Just being in the room with other colleagues as part during the week might change. Maybe it's that offices are occupied for less of the time, or maybe it's more office shares go on. So yeah, I think there could be an opportunity for some conversions to residential where businesses, well, for one, maybe they've gone out of business so they don't need the offices anymore, or they realise they can work fine without them. So yeah, I think there could be an opportunity for that. But I think, yeah, the high street, I'm very interested to see what gets adjusted there based on that it's really just accelerating the decline of the high street in a way that we all kind of knew was coming, but it's just come a lot quicker. So I think it's going to be interesting to see how that adjusts after the lockdown starts to release.
Yeah, absolutely. I think especially with that, so a lot of the high street, it's going to really focus on them having an online presence. Really, I think Primark, they've made they were doing kind of 650 million a month. I think they said,
Yeah.
And now they've got nothing just because they've not got a website. Whereas Amazon aren't faring as badly. So maybe a lot of people might look to diversify away, have smaller shops and a greater online presence, which is going to free up a lot of commercial space for different uses.
Yeah, absolutely.
Okay, perfect. So we're almost up. What we'll do now is we've got quite a few people that have done the Scalability Scorecard assessment. And really just urge everyone else to do that. We've got close to 300 people on this. So even if you can't donate, if everybody does this, that'll be close to £1,500 NHS. So everybody go to property-strategy.com/the-scalability-score. The link's there, the link's on the screen. I'll post it on YouTube. Everyone just complete that. Even if you can't donate, just complete that, and then that's in lieu of a donation. But ideally, do both. Perfect. I think we're happy to wrap that up now.
Awesome.
And get Ashley and Emmanuel on. Thank you very much for that. That was really thorough, really useful. Everyone enjoyed that. It was really great.
Thank you so much for having me. Good luck with the rest of the weekend. It's awesome. Thanks, Josh. Well done.
Perfect. See ya.
See you soon. Bye-bye.
Bye.